before I even start off at all, those of you who are very intuitive will realize that I am an Irishman. And as a consequence, you will probably not understand anything I say. That's why foreign exchange is very complex. It's all part and parcel of our plan, and that's how we do it. My name is Morgan MacDonald. I'm president of the ACI in the UK, which is only one chapter of the ACI. ACI is a global organization operating in 64 countries with 14,000 members. By way of introduction, we were founded over 50 years ago by the Bank of England and the Banque de France. And the purpose of our group being founded was to be a self-regulating body. Even then, they smelt the fear. They didn't want the government to get involved. The two central banks came together and said, look, we need to do something about this. So they established the ACI, which stands for the Association Cambisto International, to be that self-regulating body. It has morphed over the years. We are now a financial markets association. We cover more than just foreign exchange, and we cover all asset classes. We are slightly different. We are an individuals organization, as in it's members only. We are not run by a bank. We don't have bank members. So we don't have the influences of a balance sheet. We don't have shareholders saying we want higher yields, higher returns, and we don't necessarily have to kind of worry about our brand image so much. We are, as I say, a members organization. We operate under 4 pillars. Those 4 pillars are education, charity, networking, and the model code. And I will be referring to the model code a fair bit as we go through this, because I think it's very important when we're discussing regulation that we discuss where we stand as players ourselves. We also offer mediation services, and of course, being a neutral trade body, our council is asked by the regulators for our input, where we see best practice, and basically what we want to see happening in the markets. We have pushed the model code. The model code is basically a set of ethics and a guidebook basically telling you how to trade. There has been a big demand for it. I think everybody agrees for one, but we need to see exactly where we're going to go with that. So to move on, I don't think these headlines need any introduction. They're hardly new. I don't think a day goes by without us hearing of another huge fine, another big penalty loaded on a bank, a dealer or a trader suspended, or in some cases fired. We even have banks building up contingency funds for fines that they don't know what they're going to be fined for, but let's put money aside because we must have done something wrong because everybody said we're going to do something wrong, so we probably did, and let's pay the fine. We've got a lot of that going on. But we also know from these headlines that there is something intrinsically wrong. We also know that from the investigations into some of the chat rooms, where we had these wonderful names like, hey, I'm one of the bandits in foreign exchange, and hey, I belong to the cartel of foreign exchange, we knew then that there was something wrong, and something needed to be done. But the question is, what needs to be done? Is more regulation the answer? Or in the case of foreign exchange, do we introduce regulation? Or do we enforce the current laws that are there? All the dealers and traders that have been suspended, or in some cases charged, have been charged with laws that were already in place, not with new laws that came in post-crisis that somebody made up. Those laws are already in place. So there is a section of the market that believes that, why are we fining the banks? We should be fining less and imprisoning more. Is that where we want to be? Well, not if you're a former trader or dealer like I am. I think we should fine the banks, because I don't work for the bank anymore. What they're saying is, if we do keep fining the banks, who actually are we fining? We're fining the shareholder. We're fining the customer, who is also the pension fund, who's also looking after that 80-year-old woman on the street that we're all so desperate to protect. So is the answer throw away the key, put the guy in prison and fine? I would say probably. But it is important to realize that that's not the way it's going to be. Regulation is going to come in heavily. There's going to be decisions made, possibly some knee-jerk. I think that's probably one of our biggest concerns is knee-jerk regulation. It's like politically popular laws. We know historically they never work. They get the front line of the Evening Standard, they get the front line of Der Spiegel, they get the front line of all the newspapers, but fundamentally they never work. They're ill-conceived because nobody has looked at the term that has been well coined now, unintended consequence. Also, it doesn't help that a lot of people here who would consider themselves buy-side go, nothing to do with me, sell-side, I'm over here. No, sorry, actually, I'm not, I'm over here. I knew nothing. And yet you're running some of the biggest corporate flows in the world. It's all our responsibility. And we've got to be very, very careful because when the changes do come in, It's going to affect every single solitary one of us. Now, I don't know if you can see that. That is a regulator holding his foot up with a gun. A little contentious, perhaps, but it is true. It's one thing that we have to be very, very, very careful that we don't shoot ourselves in the foot. When we're implementing regulatory change, we should look for what we are trying to achieve and what the possible fallout is going to be. And obviously, it's easy to go back and discuss LIBOR and say, well, was that a good case study or a bad case study? Everybody came out and said, LIBOR's rotten, LIBOR's this, awful, awful, awful. People have been conned. Well, we don't know actually who was conned and who lost, but we know people, well, they kind of didn't really. And the benchmark was good, yeah, trillions settled on it every day. So we're going back, is it good just to attack that? Possibly not. And we've got to look at pinpointing and picking on individual things like that. It just does our market no good. The other is one regulator coming in and saying, no, I am the best regulator and I'm going to do it first. Sorry? You have just created what we call regulatory arbitrage. It's very difficult to sit there and know, I can do a forward this way if I'm here, but I can't do it over here. I can clear it here, but I can't post it here. So what have you done? You've brought in something as a regulator to create nice, calm markets, and you've created chaos. And what you have probably done as well is create flight. As in, we all know where we have to go. We have to go where the book is. We have a responsibility to that 80-year-old woman in the street that we're all very keen to protect. Another kind of unintended consequences of legislation. In the last possibly 2 years, 3 years, but noticeably about 3 years ago particularly, and it's still staying that way, we have seen a significant drop in FX forward flow. Now, FX forward flow, for those of you who are not FX traders, is basically like a spot trade that goes out for a long time. So if you are selling into Europe and you're a UK, you might say, okay, I want to sell euros in 3 months' time, because that's when they're going to pay you. So it's called a forward trade. An excellent tool for every corporate treasurer. Absolutely loves them. But what happened? We said, we think we're going to make you clear this. We think we might make you post it. Then Emir came out and said, well, you have to do it under this agreement. But Emir didn't tell us what agreement to do it under. So you had bankers and you had corporates and you had asset managers and pension funds going, no, I want a bilateral agreement. No, 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 I want to do it under ISDA protocol. ISDA protocol sounds more clever, so I went to ISDA protocol because somebody else does the work. It's far easier than a bilateral agreement. But so we didn't have agreement. So then corporate treasurers ring and they kind of go, do you know what? It's not too bad. Things are fairly calm. Look where interest rates are. You're getting yourself into a mess. Leave it. So we now have billions, if not trillions, of unhedged risk in corporate markets where it doesn't have a place, because that's not the purpose of those markets, and that's not actually what those corporate treasurers want. So what happens when the volatility comes back? Because it will come back. And you're going to go in and try and get a price, it's gone. Now, the other one is the punitive regulation that comes in. And what do I mean by that? To prove a point regulation. We've had 2 or 3 of these already. And we've seen people exiting markets. What do we mean by exiting markets? In the basic level, a lot of major banks are actually not offering clearing services. Why? It's too difficult. If a regulator wants to bring in a rule and they want to build a wall, that's fine. Building a wall is not necessarily a bad thing. Nobody is afraid of good regulation. If the regulator wants me to climb that wall, make sure that I and the market participants have the capability to climb the wall. Because if the wall is too high, where do I put my resource? I put my resource about going around the wall, which is a much better way. Now, I'll still be totally legal, because I will have my lawyers and I'll have everything, and I've been burnt in 2008, 2009, but now I'm going to go all the way around, and the regulator has facilitated market participants bypassing everything that they wanted to do. And why? Because they're not involving the industry enough, and this is where we come in. And of course, as I said earlier, the other real downside is we all walk away. The markets were there for a reason. They were there normally to provide the corporate sector or the asset management sector. That's where the demand comes from. And if we can't provide it and we walk away, there's a gap. We have created more risk. I think I've done that one. Oh, sorry, Wookie, I'm still on that. And the last one I really wanted to talk about on this particular section is price, try and speak English, that's the Irish influence coming over once again, please keep up, is price transparency. Clearness, not easy to say. Everyone, fantastic. The regulator is all over price transparency. This is brilliant. The horrible sell side, we have got them. We're going to nail them between the eyes. You know where I'm going to go with this, don't you? Really? Like, really? So, if we look at MiFID II, another wonderful piece of regulation being driven by everybody banging on price transparency, if we actually get what they want, and you come through to me on a multi-platform, so there's multiple prices coming in, and I'm sure a lot of our corporate treasurers here use those particular tools, and you ask me for a derivative. Now, that derivative could be something terribly complex, barrier options, structured options, or it could be, in some jurisdictions, a forward. Then when we were talking about the forward essay, the simplest thing you could possibly, they now like calling that a derivative. And you come in and you ask me for 9 months in €500. Under this legislation, I've got to be transparent. So I'll go, of course, but hang on a second. Anybody else there interested in a 500 6-month euro swap? Anybody? And I'll show it to all my clients who are of a similar style. And you'll go, hang on a second, I was asking you. And I said, no, just being transparent, just being transparent. And I make the price. And guess what? I'm a good banker, so it's a good price. And you got to go, do you know what? And I go, done. Because one of my other clients hit the price. No, I don't have to do it twice, because I've been transparent. And you're going to go, but I want to, no, I'm finished now. Thanks. Done. Thank you. Going home lunch. I just done 500. Oh, terribly sorry. And because you missed that pretty good price, everybody now knows that you're short. Because that was a brilliant offer, and that's why that guy took it. So the guy who asked it, who didn't get it, now knows when he goes to the next bank, that wonderful offer, yeah, it'll be about 3 or 4 ticks higher. Because all those customers are going to go back in and say, I'm going to ask that price because this is a great game and it's legal. And the sell side's going to go, doesn't matter to me, I'm out. So was price transparency a good thing? I would suggest not. Not in that guise. And it's going back to where we've got to be very careful on legislation. Good legislation is good, bad legislation is criminal. Now the free lunch, this actually has to kind of really go in because I always feel that the sell side gets bashed, the buy side gets lunch, but that is a banking lunch, isn't it? It's free as long as you buy 2 drinks, you look after the tip, you pay the taxis. Oh no, I forgot my wallet. So that's the banking free lunch. But what do I mean kind of by this is we do have to be fair. The sell side did get it wrong. They made a few mistakes. They made a lot of mistakes. But I'm going back to, I would still dictate that it's more individuals than organizations. The organizations should have been more vigilant, but they made mistakes. Has the sell side exploited this? Absolutely. Of course, I could say you have, but I'm sure you would not have done it. Of course, it has happened that the buy side has exploited this, and rightly so. Why not? You want tighter spreads? Yes, of course you get tighter spreads. Free reporting, I have it here in the bag, and it comes with a cuddly toy. And over there, I'm doing coffee as well, and you get it all. And then you're pushing for agency. I want to get into your market, actually, because I think you might be taking 1/8 of a pip of 1/8. So I want to get in through agency, but I want to use your bank. And I want to go to your high-frequency traders. High frequency, how nice. And we go, yes, yes, yes. And then our margins are down to here. So where's my skin in the game? And I'm putting the hat and sell side on for the moment. Where's my skin in the game? Well, I've none. I'll charge you a fee. We've had that up front because you want me as an agent now, don't you? You don't want me to play anymore because you've pushed me right to the very edge, and I'm on the edge here. So off you go. And then it comes the crisis. Yeah, because we all have a lot of crisis. And when the crisis comes, you're going to go, oh, Morgan, seriously, I need a price in cable, which is sterling versus dollar, in 50 quid. And I kind of go, yeah, I'll put you through the machine to the agent. And I still get my pip, I don't care. And you went, no, but there's nobody there anymore because there's a crisis. And I'm going, yeah, I know, that's not really my problem. And he went, well, where's the liquidity? Oh, no, I should have told you, the high-frequency traders, they go when there's a crisis. They give you a great umbrella when the sun shines. And once it starts to rain, you will not see them for the dust. They're out the door. So you're kind of going, but I need, and I'm kind of going, well, okay, as your agent, I'll broker you a deal. I'll go buy side to buy side maybe. Is that a win? Yeah, I'm sure the regulator's going to love this. So I'm going to say, will you make them a price? You can do it on Tuesday. And you want it Friday week. We're near. We've got Friday week over here, we got Tuesday, all right? So I might even warehouse some of that risk. But the problem is now the spreads have gone that way, haven't they? And the market that you could have dealt with your bank for maybe a pip, 2 pips, or 3 pips is now percentage points in the difference. And everyone's going, he's only dramatically advertising that, he's only pushing it. That's not true. It is true. And those of us who have been in the market over 20 years have seen it 5 times in 20 years in major currency pairs. I am not talking emerging markets. Right? So it has happened, and you would see percentage differences. So the wonderful P&L that was saved for 6 months could be wiped out in a day because there is no relationship, there is no execution. Banks can't keep credit lines. If you don't use them, you lose them. You know, you're being hit by MiFID II on one side, you're being hit by Basel III on capital on the other. If I have a line there, I need to put capital to it. I need to pay for my capital. It's gone. So even if I wanted to help you out, I have to go to credit, and everybody knows that takes, what, 4 or 5 years as a rule? Normally they're at a conference. Oh, that's a bad example there. Normally they're at lunch. Other things you do see is, you do tie in, is the negative rate scenario. That the regulator has implied that when they're charging zero rates, the buy side is not to be charged anything. All right, which is fair enough if I can get zero rates. But if I can't get zero rates, can I pass it on? No. So what's that going to do? I'm going to pull out of those emerging markets like, oh yeah, the Swiss franc. I think we all know that's a bit of a stalwart, 0%. You go to do a swap in Swiss francs. What are the interest rates of Swiss francs in a 1 month swap? It's 25 minus 25, 25 basis points over if you want to borrow it, 25 basis points under if you want to give it to me. But I can't pass that on. So now I do very, very little Swiss. I pull it away as far as I possibly can. I have to say the buy side in Switzerland has stepped up to this, and I have the pension funds and asset managers. They're moving much further out the curve where there is a possibility for gain. But the regulator didn't drive that change. The participants drove that change. And that's the key difference. Right, I'm going to finish off on relationships and how important I believe that they are. I alluded earlier on to a model code. And what is a model code? A model code is something that you prescribe through, you commit to, you believe in, and you follow. In the foreign exchange market particularly, this is where it came out first, when we started over 50 years ago, saying we have to regulate ourselves. We must continue to do so because the regulator is going to continue to make mistakes. So far, we have seen about 3 examples. I had about 50, but having said that, I might want to work for a regulator in the future, so I'm going to keep the other 400 to myself. But there's 3 there that, you know, if you look at, and as a corporate treasurer or an interbank player, it's going to cost you hundreds of millions. Right? It's going to cost you hundreds of millions. So we need to go back and we need to say to the regulators, you know what, involve us, the participants, the players, and you know, how do we do it? Well, we say in ACI, we sign up to a model code that says, I will do the right thing. The right thing is not saying, glass door, I closed the glass door and I didn't say anything. And somebody walks into it and go, nothing to do with me, because it's a glass door. Doing the right thing is putting a green sticker on that glass door. And saying, by the way, just look at the green sticker, it's not clear, it's glass. That's the right thing. That's saying to a market participant, why are you doing those futures? Why are you doing those FRAs? Why are you issuing that bond in that way? Why are you doing those forwards to eliminate risk? There's no value. You're costing yourself money. But did you ever consider about doing it this way? And vice versa, it's asked the buy side saying, excuse me, I am not going to deal with a bank that doesn't have the model code or prescribe, obviously in my case, to the ACI model code. Why would I? You too have responsibilities to your pension funds, to your clients, to your customers, and say, I have done my governance. I play in a market where a model code rules, and everybody I deal with follows a model code. And when the regulator comes in and kind of goes, what did you do to prove best price? Because best price, as we know, is an awful lot more than just one executed trade. Your best price is, well, my due diligence, I know the guy or girl that I deal with has signed to a model code. I know they believe in the integrity of the market. I know they never will unwittingly allow me to make a rogue trade, regardless of how profitable it is. And even in detail, if you have a barrier option maturing and you have a position against it and your client has one against it, there is a rule in the model code. So you're clear. So you kind of go to your board and your board of directors got to go, I've done my homework. Now, regulator, you do yours, invite us in and stop what's happening here. Because this is going to be a very, very dangerous, slippery slope. But I do think we can stop it. I think MiFID II is gone back into consultation. So I strongly encourage you to go back to your providers, go back to your own corporate treasurers and your own governors, and say, how can we go via our local organizations to our regulator saying, we like everything you're doing, lie, you're allowed to lie a little bit, and say, we're going to do a lot of this ourselves, can we look at this again? Because I'm buy side, transparency doesn't work for me. I know a little bit more than that. I know that I could be screwed on this. So, stop telling me how to suck eggs. And if we do that, I think as a buy and sell side, not only will we have a significantly stronger market across the board, and obviously foreign exchange has never been regulation, so I'm a little bit slow to try and get it in there, I want it out. but across all markets we'll have a stronger market, a stronger force, and we'll be able to go down to the pub in the evening and say to people, I work in the financial industry, and not get glassed. All right, thank you very much, folks. Hope you enjoy that.